Let's take the conversation forward. Mark, fantastic to have you back. Thank you for joining us. Mark, I'm literally pinching myself to look at what we were reporting in the month of March versus what we are staring at right now. I mean, somebody is getting it right and somebody is getting it wrong. March, it was panic, it was fear. We used the word financial Armageddon. Now, the same folks are using words like carnival, FOMO, and rally.
I don't really know what to comment about that, except the famous adage that you should buy low and sell high. So we always know the time to buy is when everybody's afraid, and that's what March was. But to actually go and do it takes tremendous courage, and clearly very few people have that courage because there's the great unknown. We couldn't have known back in March that the fiscal and monetary response would have been as big as it was, because our last experience with this kind of thing was the global financial crisis, and it actually took the Federal Reserve, between Bear Stearns and Lehman Brothers, there was a good 7 to 8 months before they reacted. So if we'd had to wait, 7 months before a big intervention from the Federal Reserve and the government, for sure the market would have gone down a lot more. And that's the thing you couldn't have really known back in March, except in retrospect, today we know it.
So what is the right way to approach this market? Because Mark, we both know that there are a lot of folks who are sitting on the sidelines. The list of Johnny-come-lately crowd is increasing on a daily basis. Has the train left the station? Those who miss the bus now, should they come in late, assuming that they will get something rather than waiting out is not giving them anything?
Well, the train was only in the station for 1 day. The bottom in the market was, that's the other thing that was quite amazing about the correction in March, is that typically when you have that kind of sell-off, it takes between 2 to 4 months to build a base. If you look back at all the previous sell-offs of that magnitude, like 1987, 1974, 1962, anyway, that's history. But what I want to say is that we think the market is going to go up. We think the S&P will take out new highs by the end of this month. The leadership will remain in the NASDAQ. And there's a bunch of reasons. The first is the second quarter results have started coming out. There's about 20 companies that have reported, and I admit 20 is a small number, but 80% of them have beat the consensus expectation. So if you extrapolate that and it becomes a trend, then the earnings will not be as bad in the second quarter as people had thought. The second thing I would say is on the technical side, the breadth is very strong in the market. In fact, there is something like, I think, 80% or more of companies in America trading above their 200-day moving average. If you look back in history, when you have that kind of positive momentum that's spread across the vast majority of stocks, in all instances, the market was up 12 months later. Then I think the actual virus itself, as devastating as it is now, there's 170 different organizations working on a vaccine. We think there will be a vaccine within 6 months. And then you have the recovery in economies. The most important one for global growth is China. And what I would point to specifically is that Caixin, which is their private sector service sector PMI, registered new orders in the month of June. It's 57.3. It's a very robust number. And given service sector 60% of their GDP, private sector 60% of their GDP as well, that shows you that China's economy will be registering better numbers in the month ahead.
The kind of astounding recovery that we've seen, not just for India, but across the globe as well. I don't know which follows what. But, one's just wondering as to what do you buy in this market? How do you participate given how swift the rally has been? Because from the March lows, there are many sitting out there on the sidelines with that FOMO or fear of missing out feeling and now want to jump in at whichever price is. Where within the Indian context, Mark, would you find deeper value, given how sharp the run-up has already been?
The value is in the mid caps and the banks and energy companies, that kind of thing, but that's not what's going to go up. We can take our lead from the United States. For the last 10 years. Well, no, it's not 10, it's more like 8. The leadership has been in the technology sector. And the great tragedy of Asia outside of China is that we surrendered all of our technology, new economy technology, to America. So we hail Ubers and we watch Netflix and we use WhatsApp to call our friends. And so basically, the only thing you've got that's anywhere near that is Reliance Industries geo platforms. And that is what's going to do well, I think, because it is going to gradually become the NASDAQ of India. It won't probably be listed in India. I imagine geo platforms will be listed in the US, unfortunately. But that is the closest thing India has to what everybody wants. And that, I think, is what will continue to go up and become a much larger constituent, well, Reliance will, a much larger constituent of the Nifty.
Mark, what's very interestingly happening in India is that it's the rural end of the economy wherein data points suggest that you're seeing a faster recovery as opposed to the urban end of the market. Be it the tractor sales, be it the FMCG companies, data points coming in from there, cement sales. It's all the tier 2, tier 3 cities which are picking up way faster than the metro cities. Do you think there's an investment opportunity here? We've seen some of the auto companies, some of those FMCG names actually hold out really well. Does it seem like this trend is here to stay, or is this just an aberration till when you see a full unlocking of the economy?
I am not an epidemiologist, but I suspect the reason for that is simply because the place where the virus is worst is in Delhi and Bombay. So that's because of population density and the inability of people to practice social distancing the way they can in the rural areas where there's more fresh air and probably people eat more nutritious food. Anyway, yes, I think there's sustainability to that trend. If you look at the jobless numbers, they were significantly improved. In other words, the unemployment dropped a lot in June over May, and the PMI rose. As much as the virus is still a terrible problem in the 2 big cities, I imagine that we're probably past the worst in the rest of the country. Therefore, those kind of ideas like tractors have momentum.
Okay. All right. Mark, what do you make of what's happening currently with regards to the spike that we've seen in Chinese markets and the vulnerability currently in the US markets, given the kind of highs they continue to trade at? What's the potential risk that you're factoring in?
The Chinese market is in a bull market, and it's been officially sanctioned by the government. CCTV Evening News, which is their biggest evening news program, 2 days ago. I can't remember exactly what they said, but they said the bull market proves that the Chinese government's done an excellent job in handling the virus and in providing adequate stimulus. To me, that is official approval of the bull market, and one of their major financial newspapers, the Securities Daily, published a piece on Monday saying that what did they say? They said the bull market is good because it will help the economy, something like that. And that journal is also official, organ of the government. So the government has condoned and approved of this bull market. I think it has some momentum behind it because, as I said, their PMIs are rebounding very strongly in June. off of already good numbers in May. And so, yes, I think it can continue. And as I said earlier, the tragedy, in my opinion, is in Asia outside of China. There's no new economy stocks, or just one or two in each market. Some of them don't have any at all. But China has so many new economy stocks. You know the names, the big ones, Alibaba and JD and Tencent. But there are dozens and dozens of others. And they all have that same kind of very interesting structural growth story that the likes of the FANGs do in the U.S. And really, outside of China and the U.S., you don't have it anywhere else in the world, and that's what people want right now because that's growth.
Okay. All right. So given what we're seeing, then, do you also see further fund interest in emerging markets? Where does India stack up vis-a-vis China, for example, at this point? And going forward as well, what's the kind of potential that you see?
So I think the biggest thing for the emerging markets is what is the dollar going to do? We went from being bullish on the dollar to being neutral on the dollar, primarily because we were not expecting the response in Europe, fiscal and monetary, to be as strong, and has been. It'll take them a month or two to implement. Actually, maybe more than that, but they look like they're getting their act together in the way that we hadn't foreseen. So we're neutral on the dollar, which is already a positive for emerging markets because the strong dollar was certainly a hindrance to them before. And I think there are two primary reasons. The first is that emerging economies have dollar debt, so when the dollar goes up, it costs them more to service that. And number two, investors don't want to buy an emerging market if they think they're going to lose money in the currency. But what we're watching very closely is the momentum in the dollar looks like it's waning. It looks like the dollar is starting to roll over. Premature to say at this point, but it might be. And if it is, that would be the best thing for Asia. Otherwise, I don't want to sound like a broken record, but just to reiterate, the thing that really is a problem for Asia outside of China is the absence of new economy stocks. And really, to get a sustained rebound in these so-called cyclical stocks, and that would be banks, that would be energy, lots and lots of things. They're the backbone of most markets in Asia. You need a strong economy. And I think it's premature to expect a strong economy given the coronavirus is still holding a lot of things back. So I don't think the leadership is in Asia, but could be in China.
Mark, historically it is believed that when a bull market starts or when a new bull market starts, it starts with beaten down names, it starts with a new sector, it starts with something which is relatively not popular or is not very widely owned. But look at the bull market leaders. Tesla, well, everyone loves Elon Musk now. Amazon, people adore that stock. You got Google stroke Alphabet, company needs no introduction, and Apple, which perhaps could be the highest holding in all ETFs. So my question, Mark, is that what are markets telling you? If the same stocks which have made money for investors in the last 10 years, if they continue to go higher, how does one figure out where the bull market is, where the bull market is not there, or one should simply respect the price action and write these 4-5 names?
There are two things that I would say. The first is that the coronavirus is, I believe, going to leave us with an enormous amount of debt. And very few countries have the cash, to pay down that debt. It'll take them a long time to do that. And when you pile on a lot of debt, you typically have a lower rate of growth. So people will still want to go out of their way to buy growth because growth is scarce and the growth is in the technology sector. You talked about Tesla. I absolutely agree. That is the market leader. And I think where Tesla goes, the market will go. It may be we're on the cusp of some very big transition in the broader economy from General Motors to Tesla, just like General Motors would have taken over from horses and carriages 100 years ago. It might be that some extremely important technological transition is occurring or about to occur. But the second thing I just want to say, and I'll wrap up, is that in fact, this technology bull market started in 2012, so it's 8 years old. If you look back at the mega cycles, even back to the 1960s, typically they last over 8 years. Typically they last 10 to 12 years. If we think back to the Nifty 50, that's what they call the great bull market of the 1960s, the big stocks like IBM and Bell. And then in the 1970s, it was gold. And the 80s was Japan, and the 90s was the dot-coms, and the 2000s was the commodities again, energy. And then in the last decade, at least the last 8 years, has been the technology stocks, the FANGs. But those other ones, actually, they lasted longer than 8 years. The exception was the commodity supercycle. That lasted about 8 years. And so I think this one could still last another, 2 to 4 years. So there could be 2 to 4 years more to go before we get the transition. And I do just want to say one last thing is that the transition might be toward inflation, because one other corollary of the coronavirus is that I think the wealth inequality has become so extreme that governments are going to start spending a lot more money to try to distribute wealth. But I think that story also might be about 2 or 3 years away.
Mark, closing comments from me. If you have to, let's say, identify one asset class for next couple of years, and if I give you the option of buying, let's say, an S&P ETF, Bitcoin, or a brick of gold, where would you find merit in allocating capital for this decade?
Yes, well, gold for me is the safest of those bets. Bitcoin might do much better, but it's a highly volatile thing. And the S&P is great. I think it is a great store of value over the long term. But I would choose gold right now just because I think the wind is really in its sails with these extremely low interest rates, probably looking at yield curve control in much of the world. And certainly a lot of geopolitical instability, which is favorable for gold, and potentially weakness in the dollar too. So I don't think that it's going to double, but I think it could continue to give us about 6 or 7% per year in dollars. That's what it's returned, let's call it, over the last 5 years or so. And that would be enough for me, because I think it's a pretty safe investment too.
Delight to have you back on ET. Now, certainly hope to see much more of you going forward. I just want to